Hello, and welcome to the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland. Today's panelists are Mark Baumann, our Global Markets Specialist, Alan Bush, our Senior Financial Economist, and Mark Soderberg, our Senior Ag Market Specialist. Starting with the ags, Mark Soderberg, any surprises on trade tariffs in the early going of President Trump's second term?
Yeah, Trump tariff talk pretty much dominated the headlines along the campaign trail. So a little bit surprised that on day one of the second term, with over 100 executive orders signed, increased tariffs for now at least have been put off. Team Trump has indicated that they want to examine some of these current existing trade deals to determine which country are following these agreements. February 1st has been mentioned as a date for 25% tariffs to be implemented with Canada and Mexico. Notably absent, however, has been China. Recall that on Friday, prices along the ag space, they spiked on reports that Chinese President Yi and President Trump had a constructive phone conversation, and now reports suggest over the weekend that President Trump wants to visit China early in his second term. So to me, that suggests that perhaps a more favorable U.S.-China relations are being built, and if so, hope is building that we'll avoid another round of these kind of tit-for-tat tariffs. Which resulted in soybean prices falling back to $8 in 2018, 2019. So far, the soybean market appears to like it as prices hover about $1 above the lows from December, despite being in the very early stages of what's likely to be a record production in Brazil. But for prices to push any higher, I think we're going to need to see these wet conditions across northern and central growing regions of Brazil to continue, which pushing back harvest, possibly opening the door to stronger U.S. demand into China.
All right. And how have spec traders been impacting trade in the ag space?
Well, money managers and index funds have both been aggressive buyers across the ag space here in recent weeks. Last week, the money manager long position jumped out to its highest level in a year and a half. In corn, money managers, they bought nearly 39,000 contracts. This extended their long position to 292,000 with buying late last week. We think now it's well over 300,000. In beans, money managers bought 63,000 contracts last week. Now this flipped their position around to net long for the first time since December of 2023. Speculative traders, however, they remain short in meal and in pretty much across all three classes of wheat. But to me, the biggest feature from Friday's CFTC report was a huge buying by the index players. Recall a major fund, they were rebalancing their portfolio last week while also putting new money to work. The result was index funds as a whole bought nearly 114,000 contracts in the ag space. This is the most in 1 week in over a decade. To me, this suggests a lot of money being reallocated to commodities on the long side, perhaps as a hedge against inflation, reigniting under the proposed tariffs here from the Trump administration. So stay tuned. There's a lot of things at play here.
Thanks, Mark. Moving over to Alan. All right, will the U.S. dollar index recover from today's selling?
I think it will. I think there'll be a partial recovery this afternoon. Of course, the dollar today has been under a lot of pressure, and a lot of this seems to be political in nature as far as potential for tariffs. So a political trade quite often does not last that long. More important is the outlook for interest rates. So I think that's the longer term fundamental that should dominate as the interest rate differentials continue to support the dollar index over other currencies. So I think once traders refocus on the interest rates, the US dollar will resume its advance, and the Fed will again be thought to be slower to move to accommodation, as most economic reports, I think, will come in stronger than expected. At the same time that the Fed is slow to cut rates, the ECB and the Bank of England, I think, will ramp up their accommodation with interest rate cuts likely this year, more so than what we are anticipating to see from the Federal Reserve. So longer term still looks like higher for the dollar and lower for the euro currency and the pound, despite what we are seeing today.
And one last question for you, Alan. What is the outlook for Federal Reserve policy?
Okay, last week's inflation reports, the producer price index and consumer price index numbers were mostly on the softer side, which at the time put pressure on the Fed to become more accommodative. And that seems to be the prevailing view as traders still look at those inflation numbers. But I think reports going forward will show a stronger economy than most analysts believe. I think that will reverse the thinking to where the traders think that the Fed may be less accommodative. So still looks like the Fed will cut by 25 basis points at the June 18th meeting, skipping the next several meetings as far as policy. So focus on June 18th as the next interest rate cut from the Fed. And overall, I think the Fed will be very slow to lower interest rates and slower than the consensus view.
All right, thanks, Alan. And finally, moving over to Mark Bowman. What does this week's Ivory Coast cocoa arrivals suggest about the cocoa market?
All right, so we had arrivals number come out this week totaling 34,000 tons for the week ending Sunday, January 19th. This is down from 48,000 the previous week. And more importantly, it's below 41,000 from a year ago. This is the first time we've gone below previous years all year. Cumulative arrivals now running about 25% above a year ago, but below the 5-year average. So while production is better than last year, it's not setting any records. It has suggested for some time that the tight supply situation of the past 3 years is not going away very quickly. We've had 3 straight years of annual global production deficits, which means the world produced more than it consumed. Now, this is Ivory Coast's dry season, so it's not surprising to see it fall off, but to fall so dramatically in just 4 weeks does suggest that all these grower complaints about being too dry there might be something to it. And it does indicate that conditions are really taking a toll on production. Main crop is wrapping up. The mid crop starts later, and this year in the spring, rains usually resume in mid-February. So keep our eyes out on this. But in general, this seems like these rivals have dropped off pretty suddenly.
And last question for you, Mark. What does India allowing sugar exports indicate?
Okay, so India, there's been talk for about a week that India was going to resume sugar exports. They stopped them in October 2023 after a poor monsoon that year, pulled production down and sent domestic prices higher. And over the weekend, they actually did apparently make an announcement that they will allow 1 million metric tons for the 24-25 marketing year. This current move is seen as an attempt to support the domestic market. And this has been quite a turnaround from the trend through this past fall. There are ideas that even though last year's this most recent monsoon this past summer was pretty good, production took a hit from some inclement weather, maybe some too much rain in the fall and some periods of dry weather as well. There's also this idea that India wants to support its ethanol production, and so they would be reluctant to allow exports. So there are also forecasts that India's 24-25 production would fall this year to 27 million tons from 32 million last year, and below consumption around 29 million. So the fact that they are willing to resume exports is suggesting that production is actually higher than previous forecasts. And also, for a change, the story not being that they're going to really want to boost their ethanol production. What does that raises questions about what that says about the global crude supply and how it's affecting them, and what this means about potential ample supply going forward.
All right, thank you all. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you would like more information about our brokerage services, please visit admis.com. Thank you.